Affirmative. Thank you, alternate two.
I can't get projections until I can figure out which set of figures is correct.
Also, what you had talked previously about, your whole proposal, if we could get a copy of that.
Sure.
Be down from what we budgeted.
$5,000 increase is, what is the percentage here?
Yes. Do you have the number there? If he calls in, do you want me to?
I don't write up the province. As I said, my job is just to get this stuff out. But
You'll do some long-range planning. Long-range planning is very, very
yes,
good.
we need to go ahead and provide additional services out there. Just,
Yeah, we have the people. There's talented people down there. We can get a hold of a lot of people, but it's just a matter of...
Well, if you'll take the responsibility of pulling the group together to be
An
sure.
actual 163, a projected 168. It looks like
The business world has many kinds of control devices. Perhaps the most fundamental are financial controls. Like other forms of measurement, financial controls are closely tied to the planning process. Every company needs to establish financial objectives, such as the amount of profit generated by each dollar of sales, the percent return on each dollar of investment, and the share of the market it seeks to capture. Because there are economic, political, and social variables that affect these objectives, it's necessary to establish a financial control system to monitor the organization's progress. Once appropriate financial controls are developed, it's possible to identify problem areas in enough time to take corrective action, to bring performance in line with objectives, or to re-examine the original plan. This sequence of feedback leading to corrective action forms the heart of any financial control system. It's especially important in the budgetary process.
We go through the process. I think it's not much different than any other major corporation. The budget starts being built from the bottom up, and we finally make total approvals at the top once every year. The performance of a subsidiary in relation to budget is also carefully monitored. And if it gets out of kilter, if we suddenly notice a blip on the screen, our group vice president moves in very quickly to see what's happening to get it so far away from budget.
A budget is management's plan expressed in financial terms. For example, an overall plan might establish a sales increase of 2% for the coming year, based on a market analysis of the various territories, sales records from previous years, and industry trends. This same objective can be stated in budgetary terms as a specific dollar amount. Now, by using this sales revenue figure, a projection of expenses can be developed that correlates with anticipated sales and revenue figures. Revenue and expenses are then combined to form a company's income statement.
I pulled out the last budget
Statements that reconcile costs and income are used by managers who have responsibility over both functions, such as divisional executives or subsidiary managers. This integration of expense and revenue budgets is critical to the overall planning and coordination of company policy. The profit margin, or difference between cost and income,
all of that.
is an important tool in evaluating the accuracy and appropriateness of other budgets. For example, if production costs exceed the revenues projected by the sales force, then management must make major adjustments in those budgets.
Income statements also allow top management to quickly evaluate the performance of profit centers during the budget year. Now, a profit center is any department or division that contributes to an organization's profit objectives. For example, each General Motors product division is a profit center that can be evaluated on an individual basis. The degree of profit or loss is a clear indication of the success of that particular center. Some businesses organize most of their operations around profit centers and income statements. Since cash requirements are closely tied to sales, it's possible to make forecasts about cash flow in and out of the organization. A cash flow budget provides information concerning cash requirements during the budget period. Income that flows into a firm rarely coincides with the disbursements necessary to pay expenses. A cash flow budget is essentially a response to a hostile environment caused by this imbalance.
In particular, the boundaries of control of liquidity very often are different from the boundaries of control for profitability. Because in measuring the cash flows, where the money is coming from and where the money is required, it doesn't very often fall into neat divisional slots and neat departmental boundaries, and those who are responsible for spending cash and earning cash may well be different from those who've been given responsibility for earning sales or earning profits. And the second difference is that with traditionally budgeting and profit planning being based on the accounting system and on historic cost accounts, we've found that in inflationary times, the historic cost accounts tend to understate costs and overstate profits. And as a result, we can feel as though we're making profits, but find we're running out of money. And so there has also been a great emphasis on cash flow modelling and on current cost accounting as the raw material, as the foundation of liquidity planning in recent years.
Another type of budget that's used as a financial control device is the capital expenditures budget. This budget provides financial planning for the replacement and expansion of facilities and the development and manufacturing of new products, including research and development and advertising.
Capital expenditures of most organizations tend to be low when compared to its operation, other portions of its operation. Some years it'll climb quite dramatically, particularly in private industry. For example, if there's a changeover in capital of machinery, tooling, purchasing, plant, that cost could soar in any one year. When you look at it over the long run, capital expenditures tend to be a small percentage of the budget.
Finally, a production budget is intended to provide a product in sufficient quantity to meet sales requirements. It's closely tied to sales projections and finished goods inventory. The implementation of a budget requires a well-thought-out, carefully orchestrated sequence of events. First, procedures to create and approve the budget itself are established.
If you take the square root.
Then, feedback elements must be put in place to measure actual performance in relation to the approved budget.
Any control system should first speak to the protection of its resources. That is, protects against waste, and also look to the efficient use of its resources. So many times we think of internal control systems as designed to do one thing, and that is to protect against fraud. Certainly it's one aspect of an internal control system, but certainly it's not the most important aspect, even though it's very important. I've pointed out the protection against waste of an organization's resources, the effective use of those resources. I think in terms of the promotion of the policies and procedures of the organization.
At the heart of the budgeting process, there must be an understanding of the company's economic objectives for the coming year. Projections on sales levels, expected profits, and other kinds of forecasts represent the guidelines used to construct the budgets for specific operational areas.
Okay, so you think that the additional 50% or roughly 30K will do the job?
While some organizations impose budgets on lower management, most companies attempt to construct their budgets by including all managers in the process. Although this method has its problems, the advantages seem to outweigh the difficulties.
Including lower-level managers in the budget process, to me, is just so logical, so reasonable. First of all, the paramount importance of involving lower-level
level managers is probably the most hard to measure, but yet it's the most beneficial. And that is, through involving them, they build a sense of loyalty and responsibility to the organization overall. If they're excluded, how can they be loyal to the company? Another thing is we get better budget data. We get better data to build our decisions on when we involve people who are really doing the functions. The third element, and the important part of it after the budget is set, is by involving lower level managers, we get a tremendous advantage during the implementation phase. They own the results of the budget process. It's not being handed down to them by the gods and they look at their budget and go, well, this is unrealistic. They've participated in it, therefore they own it.
Once the basic budget has been compiled, it's reviewed by middle and top-level management. It's at this level that priorities are established and choices between conflicting budgetary demands are made.
Many times when managers are developing budgets, there are a number of problems that come about, and basically they come about because of human nature. If a project is not managed well, there are some just human characteristics that sort of surface. One's called greed. I want my fair share of the pot is a typical approach, and I'm going to do anything to get it. Trying to get the fair share can lead to some other kinds of tactics. One of them being that managers may inflate the values of their initial request, knowing that other people are going to do the same thing and that management will then have to deal with that. Then if you look at top-level management's reaction to that process, they will anticipate, whether that's good or bad, that managers are going to inflate their value requests, and then they will make some arbitrary cuts. So it gets to be a very, very much game play environment.
Another problem that crops up is territorialism, my being interested in my own division. Now, a lot of that is not just selfishness, but defensiveness, because they're not being managers, are not being evaluated in a holistic, realistic kind of way, so they feel they have to protect themselves. So they build hierarchies, they add new divisions to their budget, they divide already specialized areas into sub-specialized areas, and they keep building this thing. So it's an indicator that we ought to look at how we're evaluating managers. Another problem that crops up is we find out when we're making budgetary decisions and building a budget, we don't know what's happening in our organization at the deep programmatic level. We don't know why these units exist. We've lost sense of it. We've lost track of it. So these kinds of problems come up during the budget setting process, and management ought to really pay attention about it and not just forget about it once the ugliness of setting budgets is over with.
Beyond that problem with budgetary process, I see another perhaps greater one, and one that won't go away. It's in the nature of management, and that's in the use of budgets. Budgets, and for that matter plans, do two things, at least. One is to serve in the process of motivating people, and the other is to play a part in coordinating across individuals and groups in an organization. And those two roles are antithetical in a sense. One would like to set high goals for performance, reachable but high. That means if we set them high enough for a particular individual, that means that there's some chance that they won't be reached. But if we set them too low, we might not be motivating to the extent that we'd wish. So we want to set high goals. We want to use the budgets as a way of motivating and then measuring in a much more complicated management process. At the same time, it's very important for budgets to play a coordinative role. It's striking that balance in not only the budgetary process, but the planning process, which is, I think, one of the most difficult things for a manager to do, striking the right balance between those two tensions.
Once the budget is set, many large corporations turn to a budget department for the actual monitoring of accounts. The budget department is usually under the controller's office and performs the data collection for managers to use in keeping on target. Adjustments that may be necessary over time are the responsibility of a budget committee composed of top management. Its job is to approve ongoing changes in the budget, resolve conflicting monetary demands, and to make other adjustments as the fiscal year progresses.
In the last 20 years, two types of specialized budgeting procedures have gained some acceptance. The first of these was adopted by the Defense Department in the early 1960s. The Planning, Programming, Budgeting System, or PPBS, as it's come to be called, begins with a basic analysis of the objectives of the organization. Then, all ongoing and proposed spending packages are categorized according to these goals and analyzed to determine their relative importance. Next, the total projected cost of each program is measured over its entire expected life rather than only the initial startup period. During the final and most critical phase of the PPBS process, the costs and usefulness of each program are compared to alternatives. Only when this analysis is complete can the budget for a program be implemented. Because the process of constructing a PPBS budget is very demanding, it should be kept in mind that it's often met with mixed reactions.
In government, where politics dominates, it's very difficult to go through a process of comprehensive analysis and then sell a program. It's negotiated, 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 negotiated. And there's a very complex balance of payments between the people who make up the government in the various branches. So PPBS, or strategic planning, is very difficult to carry off in the government. It's also very difficult to carry off in a complex organization because a change in policy and strategies a change in politics. But the one difference is that in businesses, somehow they're less democratic. Somehow they're more hieratic. It's easier for that PPBS or the strategic point of view to dominate in a private company than it is in a public institution.
Another specialized form of budgeting gained public recognition when it was introduced into government by former President Jimmy Carter. It's called zero-based budgeting and was developed by Texas Instruments and used by President Carter when he was governor of Georgia. Standard budget procedures assume that the previous year's spending levels remain in place. Zero-based budgeting requires managers to justify their expenses with each new budget. Obviously, this forces the organization to evaluate its operations on a continuing basis. Areas that are no longer critical to the success of the business can be identified and eliminated. However, this kind of intense scrutiny on an annual basis can be very stressful for managers.
Managers tend to think that it's very, very cumbersome, very time-consuming, and there's an awful lot of paperwork involved. When we think of zero-based budgeting, originally it was thought of to be literally zero. Working with the system, we learned a great deal about zero-based budgeting. That in fact an organization cannot go to base zero, that it has assumed administrative, for example, costs associated with it if it's going to be an organization, living organization. We think of companies as being a living organization in and of themselves. It has an ongoing cost associated with it. So we backed off, for those of us who are in the profession, backed off the zero-based budgeting concept to one which is basically modified. one that says if you are given only 50% of what you received in the previous year, how would you allocate it? 70%, 80%, and then sometimes even beyond that, 110%. How would you use the additional 10% over last year's budget appropriation?
As important as budgets are to the financial control process, certain financial operations can be monitored without them. Non-budgetary financial controls include such procedures as balance sheet analyses, break-even analyses, and capital investment evaluation. A balance sheet analysis allows a firm to assess its performance by using a relatively simple mathematical procedure called ratios. Balance sheet ratios are mathematical comparisons of financial data extracted from the firm's balance sheet. For example, by dividing current assets by current liabilities, it's possible to assess the firm's ability to pay bills as they come due. Another useful ratio is called the inventory turnover ratio. When the cost of goods sold is divided by the average inventory value, the resulting ratio shows the speed at which inventory is sold and then replaced. In most cases, the faster the inventory turnover, the better the cash flow. But the ideal inventory turnover ratio varies from firm to firm and industry to industry. Another useful ratio is the profit to sales ratio. This ratio indicates the amount of profit that each dollar of sales generates. And as in inventory turnover, the profit to sales ratio varies depending on the company and the industry.
Since financial performance is relative, ratios give us an opportunity to compare performance with other firms and other industries. Another financial control method is a break-even analysis. A break-even analysis is a method that tells us when each additional unit of production begins to earn a profit. It is a point where total sales revenue and total costs are equal. The costs that are involved are fixed costs and variable costs. Fixed costs are those costs which do not change even though sales revenue increases or decreases. The fixed costs are primarily mortgage costs, sometimes managerial salaries, lease costs, real estate taxes, those costs which don't change as revenue changes. The variable costs are quite different. They are costs which will increase or decrease along with sales revenue changes. And the major variable costs are raw materials and direct labor. It is very important for us in making decisions about products and promotional strategies to determine at what point of production one additional unit will add to additional profits.
Another important non-budgetary form of financial control is capital investment evaluation. By using return on investment standards, for example, a company can allocate funds for investment to those projects that will result in the highest return. In order to determine which projects appear most promising, an analysis of the ones that are potentially profitable is made. It's unlikely that every project will provide a return on investment, that's the ratio of profit to invested capital, as high as, say, 15%. The evaluation will point out which project is the most profitable. It's also possible to calculate payback periods for each potential investment. In other words, the amount of cash generated by each potential investment and the number of years it will take to pay off the asset. In this case, the project with the shortest payback period would be selected.
As we've seen, there's a wide range of budgetary and non-budgetary methods that can be used effectively to monitor the progress of an organization. There is, however, a common element that runs through all control systems: the need for accuracy. Because of this, one of the cornerstones of any financial control system is the audit. Audits are formal investigations that determine if records, reports, statements reflect accurate information. Most large organizations maintain in-house audit teams that regularly check on the policies and procedures used to prepare financial information. In some cases, external audits are conducted to guarantee the objectivity of the financial reports. Public accounting firms use trained accountants to examine records and certify that reports are prepared according to established accounting practices.
In addition to the need for accurate financial control data, managers need a rapid turnaround of information which is useful to them. When centralized systems are unable to provide prompt feedback, managers often compensate by developing their own informal systems of financial control.
And talking to managers coming on courses in the Management Centre, we find that they very readily agree that these are the sorts of systems upon which they rely for day-to-day and week-to-week control. And the advantages are, first of all, that very often they reflect the local conditions. They are more representative of the activities that are going on locally, and they use the local language, and most departments and activities and divisions have their own language and subcultures, and we can design the control systems to reflect these. The second thing we find is very often these systems are measuring what is happening in physical terms. And since the decisions about resources and use of resources very often are also being made in physical terms, it's very often easier for the manager to make sense of these reporting systems rather than if they were translated into a financial measurement.
Of course, a large organization still requires a centralized control system to bring all the parts together. The dilemma facing financial controllers is how to allow managers to invent systems to meet their own needs, yet bring about the coordination necessary for the group as a whole. In today's complicated and changing financial environment, striking the right balance between these two tensions may well be one of management's major challenges.